So here we are. We bought back 4,000 shares. We sold off 1,500. Sold off 2,500. So we've exhausted the treasury stock account. We'd paid in excess of 6,000. We exhausted that. So the only thing left over is to take from retained earnings to make up this difference that we're lacking in. Okay. September 5th. The directors declared a $2 per share cash dividend payable October 28th to stockholders on record at September 25th. Okay, so again, we're going to wind up declaring a dividend. We're going to hit retained earnings with a debit. Oh, and back up here, this 37,500 shares outstanding. Since we ended up selling off the remaining 2,500, guess what? We're back up to $40,000 again. Outstanding shares. Okay, so folks, when you're going through this treasury stock stuff and selling treasury stocks back out again, make sure that you're tracking how many outstanding shares you've got. Because when you get down here and you have a declaration of cash dividend, you got to base it on what is outstanding in total. So now we're back up to $40,000. Okay, so 40,000 shares times $2 per share is going to be 80,000. Oops, 80,000. And then I'm going to hit the dividends payable account credit. $80,000. Okay, so retained earnings is going to be debited $80,000 here for that declaration. And then October 28th, we make the payment of dividends to stockholders on record. So I'm going to decrease that dividend payable. $80,000, and I'm going to pay cash out to the stockholders on record. Okay. Last bit. December 31st. We closed out 388,000 credit balance, which is from net income that's sitting in the income summary account, to retained earnings. So it was a credit balance on income summary, and to clear out the income summary you had to do a debit to income summary, and then the resulting credit is going to go to retained earnings. So I'm going to debit income summary. $388,000, and credit retained earnings. $388,000. So now I update this to account. Okay, that's all the activity that I need to keep track of at this point. Now, prepare journal entries. We did all that. Prepare statement of retained earnings for December 31st. Okay, so the statement of retained earnings is basically made up of beginning retained earnings plus net income minus dividends equals ending retained earnings. Okay, that's a pretty straightforward, easy way to remember it. Okay, beginning retained earnings plus net income minus cash dividends equals ending retained earnings. So let's pull up another piece of paper here. So my beginning retained earnings I'm going to look to my balance sheet from last year, at the end of last year, and beginning retained earnings was $270,000. There it is right there. Then I'm going to add net income. And what was that? That was this number right over here. Oops, I can't see it. Okay, that was this number right over here, 388,000. Okay, so net income alrighty. That totals up to be what, 658,000? Good. Less dividends, and it says it's dividends declared. That means dividends that have been already set up and ready to go. Now, one of the things that they had here was on this one we had everything paid out in cash. All the dividends have been paid out in cash. But I'll tell you what, on the EOC quiz, I believe it happens where they declared dividends but they didn't pay it out. The payment will not come out until sometime in January, but you still have to take that into consideration. So I've got to take into consideration dividends that I have already declared, and that's going to be this 72,000 right here and this 80,000 right here. Okay, in other words, 152,000. And folks, when you're doing this, please, please, please look at the retained earnings account. This is where you get your numbers right here from the retained earnings account right here. So I had a beginning retained earnings. I declared net income. I've also declared dividends, okay, and so I've subtracted out dividends, but now I've got this thing right here, this 1,500. What in the world do I do with that? I do actually have to take that into consideration, so I literally have to take that out as well. Okay, but what do I call it? Treasury stock reissuance is what they use in the book. So I'm going to call this treasury stock reissue. Okay, equals, and then 658 minus 152 minus 1,500 is going to give me 504,500, and that's ending retained earnings. Okay, so when you're looking at this beginning retained earnings, they probably won't show it to you like that. They'll probably say, well, you know, it's the retained earnings of December 31st, 2015, and this is December 31st, 2016, which effectively is beginning and ending retained earnings, but they do it by date. So watch for the date. Okay. Next part of this question, you have to do the stockholders' equity section of the company's balance sheet as of December 31st, 2016. So what that will look like is you're going to have common stock, you're going to have paid in capital or paid in excess, you're going to have retained earnings, and then you have total stockholders' equity. Okay, so my common stock, since I ended up going right back to what I had in the beginning, I had 40,000 shares and back up to 40,000 shares, I'm going to have all this verbiage up here: $10 par value, 100,000 shares authorized, 40,000 shares issued and outstanding, 400,000. Okay, so I'm still at holding at $400,000. I paid in excess. Actually, I didn't even touch this account. None of the journal entries were done here. I actually hit the paid in excess for common stock. I did paid in excess for treasury stock, but that's a totally different account, so don't get that mixed up. So it should be 60,000 for paid in excess. And then retained earnings. Retained earnings is going to come from what I just calculated right here, 504,500. Okay, so my retained earnings, 504,500. So effectively, the only thing that changed was retained earnings. Common stock, paid in excess, they stayed the same from the schedule right up here. Total, and that comes out to be 964,500. And that is total stockholders' equity. Easy peasy lemon squeezy, folks, but you really have to track this stuff, and I cannot stress enough. Use your T accounts while you're doing the journal entries here, because as long as you're keeping track of how many shares are outstanding up here for your common stock, and you keep track of your treasury stock, and you remember what the dollar amount you bought it at, so that when you sold it at more than that, you can have it paid in excess. If you sold it for less than that, you're going to dip into the paid in excess to make up that difference. And if you come up short, then the next account after that you have to hit is your retained earnings account. And when you do your statement of retained earnings, this is the statement of retained earnings. This right here is retained earnings. So when you do the statement of retained earnings, this was the this document right up here. All I do is just look at this right here, and if you kept track of everything on your journal entries, everything will be right here in the retained earnings T account, and you don't even have to think twice about it. Okay, you guys have a good day. Take care now.